Welcome, deep divers. Today we're tackling a fascinating puzzle. Imagine an insurance company that, instead of shying away from risk, actually leans into it.
Right.
I'm talking about the clients other insurers deem too dangerous, too complex, well, hazardous. Sounds counterintuitive, doesn't it?
It absolutely does.
Yeah.
I mean, most companies in the insurance world, their whole strategy is built around minimizing risk exposure.
Yeah,
So to actively seek it out, that's a fundamentally different way of thinking.
exactly. And that's what makes our deep dive today so compelling, I think. We're unpacking Amerisafe Inc., ticker AMSF. They're a specialty insurer that has carved out this incredibly profitable niche by focusing exclusively on workers' compensation to these high-hazard industries.
Yeah, and this isn't just about looking at a company's financials, it's really about unraveling how a highly specialized business model can not only survive, but actually thrive in what many would call, frankly, a terrifying market.
Totally.
So our mission today is to sort of distill the most important nuggets of knowledge from this in-depth analysis of AmeriSafe. We want to show you their unique approach, shed light on the intricate dynamics of their industry,
Right.
and reveal how they navigate these really complex financial landscapes to consistently deliver, well, pretty impressive results.
Yeah, get ready for some genuine aha moments because what Amerisafe does is quite remarkable. Whether you're just curious about the power of niche business models or maybe the inner workings of the insurance industry or just how companies differentiate themselves against the grain, you're going to come away feeling incredibly well informed today. Let's dig in.
Let's do it.
Okay, let's start with a fundamental question. How does a company even decide to focus on the riskiest clients? I mean, what is Amerisafe's core identity here?
Oh, right. Well, AmeriSafe, they're headquartered down in DeRidder, Louisiana,
Okay.
and they are a specialty insurance holding company with just a singular laser-like focus.
Yeah.
They only provide workers' compensation insurance.
Only workers' comp. Got it.
And specifically for small and mid-sized employers in inherently hazardous industries. Now, the key insight here, I think, is this. In a really crowded market, this extreme focus, kind of paradoxically, creates broader insulation and allows for superior pricing power.
Yeah.
They're really not trying to be all things to all people.
So by narrowing their scope, they actually broaden their profit potential. That's a counterintuitive but powerful strategy.
Yeah.
When you say hazardous industries, what exactly are we talking about here? Because that sounds like the kind of client most insurers would be, politely turning away.
Precisely. Yeah, we're talking about sectors where the risk of workplace injury is just significantly higher than, say, an office environment.
Sure.
Think construction that accounts for nearly half their premiums, around 47% back in 2020.
Wow, nearly half.
Yeah. Then you've got trucking, logging and lumber, agriculture, manufacturing, and even maritime operations. These are industries with, heavy machinery, physically demanding labor, inherent dangers.
And because they're in this specific segment, it changes the entire dynamic of their business, right? How they price, how they manage claims.
Absolutely. This focus means AmeriSafe operates in a pricing environment where insurance rates can be more than 3 times the national average.
3 times.
Yeah. And what truly sets them apart, and this is a key statistic, is that roughly 85% of their premiums come from the National Council on Compensation Insurance's highest risk hazard groups E through G.
Okay, so the really risky ones.
The riskiest. Essentially, the jobs with the highest chance of serious incidents. Most other insurers, they only get about half their business from these types of high-risk accounts.
Right.
So this deep specialization isn't just a claim, it's a verifiable fact baked into their business model.
So they're not just dipping their toes in, they're fully immersed in the deep end of risk, so to speak.
Exactly.
And this immersion, this intense focus, it actually insulates them from the broader market's pricing wars. You mentioned their client retention rates exceeding 90% for voluntary business in 2023. That's huge.
It is.
It's a testament to the value they provide, even in a segment others avoid.
Indeed. And to your earlier point, this monoline strategy, this singular focus, becomes a profound source of strength. It forces the organization to become intimately familiar with the unique risks, the safety protocols, the claims patterns within these specific industries.
They have to know it inside out.
They have to. They're not just selling policies, they're becoming genuine risk management partners, almost like consultants in a way. This specialization fosters an incredible depth of knowledge that generalist carriers, well, they simply can't match. It creates a significant and I think, sustainable competitive advantage.
Okay, so they've identified their unique market. But how do you take inherently hazardous industries and actually turn them into a profit machine?
Mhm.
What's the secret sauce behind that consistent profitability you mentioned?
Yeah, it truly comes down to their unwavering underwriting discipline and that deep industry expertise we just talked about. A critical element of their operating model, and this is important, is that they avoid using external intermediaries. Specifically, managing general agents, MGAs, and managing general underwriters,
Like
MGUs.
those third parties.
Exactly. These are third parties that would typically handle underwriting and claims on behalf of an insurer. By sidestepping them, Amerisafe ensures they retain direct control over every single risk selection and pricing decision.
Ah.
There's no middleman diluting their expertise or, crucially, their incentive structure.
That hands-on approach sounds like it requires a lot of trust in their internal teams. And the analysis highlights their incentive structure as, well, super interesting. Bonuses for both underwriters and their field safety professionals are tied directly to underwriting profitability, not just the sheer volume of policies written. That's a powerful alignment, wouldn't you say?
Oh, it's absolutely crucial. This alignment ensures that risk management and profitability remain the paramount objectives, always. It actively discourages underwriters from chasing premium volume at the expense of sound risk selection.
Right, don't just write anything.
Exactly. It fosters a culture of prudent underwriting where, frankly, declining a bad risk is rewarded just as much as writing a good one. This direct tie between individual performance and the company's bottom line is a powerful cultural lever.
And the proof is in the pudding, as they say.
It is. The proof of this philosophy's success is pretty stark. An impressive average combined ratio of 86.0% over the 19-year period from 2006 to 2024.
86% average. That combined ratio is fantastic. And just for folks maybe newer to insurance metrics, that's essentially a measure of an insurer's underwriting profitability.
Hmm.
If it's below 100%, they're making money on their policies before even considering investment income.
That's right.
So an 86% combined ratio means for every dollar they take in premiums, they're only spending 86 cents on claims and expenses. That leaves a significant profit just from the core insurance business itself.
Yeah.
That's an enviable position.
It really is. Very few achieve that consistently.
So that kind of consistent profitability, it doesn't happen by accident. The analysis describes Amerisafe's business model as a cohesive, self-reinforcing system designed to generate those superior underwriting profits. It connects their high-hazard niche with strict pricing and those internal incentives, creating what you called earlier kind of a virtuous cycle. Can you walk us through how that system, connecting the niche with the pricing and incentives, actually works on the ground? How does it create that virtuous cycle?
Absolutely. It truly is a holistic approach, where their philosophy is executed through a very proactive, high-touch service model that manages risk at every single stage. For instance, right from the get-go, even before they quote a policy, they're already in action with their safety services.
Okay, so it's not just about assessing risk after the fact, but preventing it beforehand. You mentioned pre-quotation worksite safety inspections. That's quite a mouthful, but it sounds incredibly proactive.
Mhm.
How do these field safety professionals, the FSPs, actually engage with the potential client?
Right. So it means their FSPs conduct these detailed inspections on over 92% of new accounts before a quote is even given.
92%.
Yeah. This isn't just about ticking a box. It's proactive engagement that aids in really accurate risk assessment and therefore accurate pricing. But it also serves as a crucial value-added service for their policyholders.
How so?
Well, by identifying potential hazards and suggesting improvements, they actually help clients mitigate risks, reduce workplace incidents, and ultimately lower their insurance costs over time. It's a win-win, really. It fosters a true partnership.
That's a huge differentiator. So they're not just insuring risk, they're actively helping to reduce it. That builds loyalty, I imagine.
It does.
And once a claim does occur, how do they handle the inherently high severity nature of claims in these industries? Because a construction accident, for example, can be incredibly complex and costly.
Yeah, absolutely. And that's where their intensive claims management model comes into play. Given the potential for serious injuries, Amerisafe employs field case managers, or FCMs. These FCMs are geographically dispersed, close to the policyholders, and they maintain incredibly low caseloads, fewer than 45 claims per manager.
That is low.
It is, and this allows for focused individual attention on each claim, with a strong emphasis on timely resolution. The goal is to prevent unfavorable development, meaning claims getting more expensive or complicated over time, and ensure injured workers receive appropriate, effective care. This high-touch, almost empathetic approach is crucial for managing both costs and outcomes.
Mhm.
And it's really a hallmark of a truly specialized insurer. They're not just processing paper, they're managing recoveries.
And it all wraps up with their reserving philosophy, which the analysis calls conservative and effective. That's where they set aside money for future claims payments.
Yes. Management's practice is to set initial case reserves at what they deem the most probable outcome.
Okay.
And this disciplined approach has led to an extraordinary track record. 17 consecutive years of favorable prior year loss reserve development.
Wow, 17 consecutive years of favorable reserve development. That's almost unheard of in the insurance world. It implies they consistently over-reserved. Right. They put aside more money for claims than they actually ended up needing to pay out. But in an industry with so many variables, is there any risk that this could just be a run of good luck? Or is there something fundamentally different in AmeriSafe's approach that truly underpins it?
That's a great question, and it really gets to the core of their operational excellence. It's almost certainly not luck. It's the direct result of that integrated system we've been discussing.
The system again?
Exactly. The pre-quote safety inspections lead to better initial risk selection. The proactive safety services reduce the frequency and severity of claims that do happen. And the intensive low caseload claims management ensures claims are handled efficiently and effectively, preventing them from spiraling out of control.
Okay.
This means their initial assessment of the most probable outcome is incredibly accurate based on deep experience, and often through their active management, they achieve outcomes better than initially predicted.
Got it.
And to put it into numbers, over the last decade alone, from 2015 to 2024, this disciplined approach has resulted in over $486 million in favorable reserve development flowing back into earnings.
Nearly $500 million.
Yeah, this is a powerful testament to the accuracy of their underwriting and the effectiveness of their entire risk management system.
Yeah.
It's not just one thing, it's everything working together.
That makes perfect sense. So for the policyholder, it means safer workplaces, fewer accidents, and when incidents do occur, timely and appropriate care for injured workers, which ultimately reduces their long-term costs and disruption.
Right.
And for the company, AmeriSafe, this proactive and disciplined approach leads directly to lower loss ratios, less money paid out in claims, which is a key driver of their superior underwriting profits. It really is a holistic system where each part reinforces the other, building trust with clients and driving consistent profitability.
That's a great summary. It's that virtuous cycle in action.
Okay, so AmeriSafe isn't just focused on what they insure, but also where they insure it. They actively market in 27 states and are licensed in an additional 20 states and the U.S. Virgin Islands. That gives them a good spread against local economic or regulatory bumps, I suppose.
It does provide geographic diversification, yes.
And critically, they hold an A, excellent financial strength rating, from AM Best, which is essentially their badge of trustworthiness in the insurance world. Super important.
Absolutely vital. That A rating is non-negotiable for credibility with agents and policyholders. They wouldn't get far without it.
But this monoline focus, this deep specialization, it does come with a trade-off, right? A concentration risk.
Precisely. That geographic spread helps, and the A rating is crucial. But you hit on the critical point. While their specialization fosters unmatched expertise, it also ties the company's fortunes directly to the health of the workers' compensation market itself and the specific high-hazard industries it serves.
So if construction tanks.
Exactly. A severe, prolonged downturn in construction or trucking, for example, would be a direct hit to their premium base. It's the inherent trade-off, the flip side of the coin, for their chosen path of extreme specialization.
Okay, that sets the stage really well for AmeriSafe itself. Now, we've established their highly specialized internal engine, but no matter how good an engine, it still has to run on a road. Let's shift our focus to that road, the broader workers' compensation industry. What's the terrain like out there for them right now?
Good analogy. The U.S. workers' compensation market is, well, it's a mature and substantial segment of the broader property and casualty industry.
Yeah. Big market.
It is. For private carriers, the net written premium was over $42 billion back in 2022, growing modestly to $43 billion in 2023. More recent data, however, indicates a slight softening, maybe a plateauing. Total direct premiums written declined slightly to approximately $57.5 billion in 2024.
And this market is highly correlated with the overall economy, isn't it?
Yeah.
The economy slows down, people lose jobs, payrolls shrink. That hits workers' comp premiums.
That's absolutely right. Premium volume in the sector is highly correlated with macroeconomic activity, particularly payroll growth. It's a direct function of employment levels and wage increases.
Makes sense.
More people working, earning more, typically translates to higher premiums for insurers. So yeah, a healthy economy generally means a healthy workers' comp market.
So a strong economy is good for business.
Mm.
And the industry has actually seen some unusually good times recently, right? Like historically profitable.
Unprecedentedly good is probably the right word. The industry has enjoyed 9 consecutive years of underwriting gains through 2023.
9 years.
9 years. The private carrier combined ratio, that measure of underwriting profitability we discussed, was exceptionally strong at 84.0% in 2022 and 85.9% in 2023.
Wow.
That marks the 6th and 7th consecutive years, respectively, with a combined ratio below 90%, which is, very profitable territory.
Then why was it so good for so long?
Well, this extended profitability was driven primarily by 2 big factors. Declining claim frequency, meaning fewer accidents overall, possibly due to better safety practices,
Okay.
and significant favorable reserve development across the industry, like we saw with Amerisafe, but on a broader scale. But somewhat ironically, this long stretch of good times has led to what's known in the industry as a soft market.
Ah, the soft market.
Yeah.
Intense competition, prices get pushed down.
Exactly. Characterized by intense competition and downward pressure on premium rates as insurers fight for market share in a profitable environment.
So even with those stellar industry-wide numbers, it's a soft market because of competition. And the analysis highlights that this market is highly fragmented. What does that mean for a company like Amerisafe that's so focused?
It means they face a pretty diverse set of competitors, and it really varies significantly depending on the size of the policyholder.
Okay.
For their largest accounts, let's say those with annual premiums over $100,000, they're typically up against the major national carriers, think Travelers, the Hartford, AmTrust Financial Services, big names.
Right, the giants.
In the mid-size market, it's more regional firms and smaller national firms.
But the bulk of Amerisafe's policies are smaller, right? You said less than $35,000 in premiums was a big chunk.
Exactly. For those policies, which represent a significant portion, nearly 80% of their total policies by count and about 45% of their premium dollars, the competition consists primarily of small, often single-state writers and various self-insured funds.
Okay.
Now, this fragmentation at the smaller end of the market can sometimes lead to what the analysis calls irrational pricing behavior. Meaning competitors who are maybe more focused on just gaining market share than on achieving sustainable profitability. They might underprice the risk.
Gotcha. And that's a critical point for companies like Amerisafe that prioritize profit over just grabbing market share, right?
Yeah, absolutely critical.
That raises an important question then. What are the implications of this fragmentation? Especially that irrational pricing behavior at the smaller end for a company like Amerisafe. Do they ever feel pressure to match those, potentially crazy low prices, even if it means sacrificing some of their own hard-earned profitability?
That's a truly insightful question, and it's where their discipline really has to shine. While these smaller players might offer lower rates to grab market share quickly, they often lack the deep expertise and those integrated risk management systems that Amerisafe possesses.
Right, the whole system we talked about.
Exactly. This means they might underprice the actual risk involved, leading to poorer underwriting results for them down the road. For Amerisafe, it means they have to be disciplined enough to walk away from business that doesn't meet their stringent profitability thresholds, even if it means sacrificing some premium volume in the short term.
Tough call sometimes, I bet.
It can be. But they fundamentally believe that chasing unprofitable growth is a losing game in the long run. Their key publicly traded peer, Employers Holdings, Inc., EIG, also navigates this dynamic. But Amerisafe's higher hazard focus makes this discipline even more critical because the consequences of mispricing in their niche are potentially much higher.
Okay, so a soft market, fragmented competition, and Amerisafe needing extreme discipline. It sounds like the industry is at a bit of a crossroads. The analysis says it's a critical inflection point. What does that mean for companies like Amerisafe? What's changing?
It means those historical tailwinds that have propelled industry profitability for nearly a decade, they seem to be diminishing, and new headwinds are emerging.
Like what?
Well, first, that long cycle of strong profitability has attracted competition, leading to negative average rate changes for several years now. Prices are going down, generally. And NCCI rate filings for 2025, they continue this trend, with approved decreases in premium rates in nearly every state. So pricing pressure is a major factor. Insurers are being forced to get more competitive on price or become much more efficient.
And it's not just falling rates squeezing them.
Right?
Claim severity, the cost per claim is also rising, which sounds like a double whammy.
It is indeed. The industry faces rising claim severity driven by both medical and wage inflation. In 2024, medical severity, the average cost of a medical claim rose 6.1%,
Wow.
and indemnity severity, the average cost of wage replacement benefits, increased 6.0%. That's outpacing general wage growth.
Why is medical going up so much?
It seems that increased utilization of medical services is a primary cost driver, not just price inflation per service. People are getting more treatments, more complex treatments.
Okay.
So this combination of falling revenue per unit of risk due to declining rates and rising cost per claim due to increasing severity creates what the analysis calls a classic margin compression scenario for insurers, squeezed from both sides.
Not ideal. And if that wasn't enough, it sounds like a long-standing buffer for insurers is also shrinking. Something about reserves.
Exactly. That significant buffer of industry-wide reserve redundancy, basically. Extra money set aside in the past that insurers could release into earnings, which has supported underwriting profits for years, well, it's beginning to shrink for the first time in recent memory.
So that cushion is getting thinner.
It is. This suggests that this key source of favorable earnings development may be waning for the industry as a whole. The conclusion seems pretty clear. The era of broad, industry-wide tailwinds appears to be ending. This places an even greater premium on company-specific execution and disciplined underwriting just to maintain profitability going forward. It's getting tougher out there.
So given all these challenges, the soft market, the margin compression, the shrinking reserves, and the fact that Amerisafe is doing so well in this specific niche, why isn't everyone trying to jump into their high-hazard workers' compensation market? What keeps competitors out? What are the barriers to entry?
Yeah, that's a key question. There are substantial barriers to entry. First, you have the obvious regulatory and capital barriers.
Okay.
Significant regulatory capital requirements, the need for state-by-state licensing and rate approvals, which is cumbersome, and the absolute necessity of a strong financial strength rating from AM Best to gain credibility with agents and policyholders. You can't even play without those.
Right, table stakes.
But what's truly formidable, especially for Amerisafe's niche, is the deep, specialized expertise required to accurately price and manage risk in these high-hazard industries. This isn't something you can just pick up overnight or, learn from a textbook. It takes years.
That sounds like the ultimate competitive advantage, doesn't it?
Yeah.
The sheer knowledge barrier, the institutional memory.
It absolutely is. Durable competitive advantages, or moats, as they're often called, are built on this specialized knowledge. That, combined with disciplined risk selection, efficient and effective claims handling, and strong long-term relationships with distribution partners. These are the elements that make it incredibly difficult for new entrants or even large generalists to compete effectively against an established, focused player like Amerisafe, even if they had the capital to try. It's years and years of accumulated hard-won experience.
Okay, so Amerisafe operates in this challenging but specialized market, and they seem to be thriving despite the headwinds. Let's delve deeper now into what truly makes them stand out, their competitive position and differentiation. Why is their success so hard to replicate? Let's talk about that economic moat.
Right. Amerisafe's competitive advantage, their economic moat, is really rooted in what we refer to as intangible assets.
Intangible assets, like brand name or...
Not quite like brand name in this case. Specifically, this refers to the specialized institutional knowledge required to successfully underwrite and service these high-hazard industries. It's the collective expertise cultivated over decades, built by literally thousands of underwriting decisions and millions of claims data points.
So it's embedded knowledge.
Exactly. And that kind of deep, granular understanding is incredibly difficult and costly for generalist carriers to replicate. They simply don't have the history or the singular focus needed to build that specific know-how.
So it's their collective brainpower and experience, really embedding that knowledge deep into the company's DNA over time.
Precisely. And this moat, this knowledge advantage, is further reinforced by their integrated business model. Remember those pre-quote safety inspections?
Yeah.
And the direct underwriting control, the in-house low caseload claims management. All those pieces create a holistic risk management system that demonstrably lowers the total cost of claims for them. It's a systemic advantage, not just a series of individual strengths. Each piece works together, amplifying the effect of the others.
It sounds like more than just a set of processes, though. The analysis mentions a culture of ownership. How important is this culture of ownership when trying to understand a company's long-term viability, especially in a competitive, sometimes irrational market like this?
Oh, it's paramount. It's absolutely critical. In an industry like insurance, where underwriting discipline is truly everything, and the temptation to chase market share, especially in a soft market, can be so strong.
Right.
A culture that explicitly prioritizes profitability and rigorous risk selection is a formidable competitive barrier in itself. Think
Wow.
about it. By eschewing those external MGAs, Amerisafe retains full control of the underwriting pin. They decide what risks to take.
Hmm.
And by tying bonuses directly to profit instead of just volume, they ensure underwriters are actually rewarded for declining bad risks, not just for writing more and more premiums, regardless of quality.
Alignment is key.
It is. This cultural advantage is difficult to quantify on a spreadsheet, but it's profoundly reflected in their superior long-term results. And that very sticky customer base, we talked about renewal retention rates consistently above 93%. It means that even when the broader market engages in maybe some irrational pricing, AmeriSafe's internal compass is firmly set towards long-term value creation. That makes them far more resilient. This deep cultural commitment ensures that their intangible assets, their knowledge, aren't just static information, but are actively applied and reinforced by every decision made throughout the organization.
And that culture clearly translates into numbers. The analysis states that AmeriSafe's superior business model translates directly into quantifiable, best-in-class underwriting performance. Can you give us some of those key numbers again to really paint the picture of how they stack up?
Indeed, the numbers really tell the story. That long-term average combined ratio of 86.0% from 2006 to 2024, that stands as clear evidence of its ability to consistently generate underwriting profits, even in a very cyclical industry.
Yeah, 86% is stellar.
It is, and this level of outperformance is rare, and it's the primary driver of their financial success. According to company reports that cite AM Best data, AmeriSafe's return on surplus, which is a key measure of how efficiently an insurer uses its capital base to generate profits, consistently and significantly outperforms its workers' compensation peer group.
Okay.
That's a direct result of these favorable underwriting results year after year. And furthermore, that multi-decade trend of favorable prior year reserve development we discussed earlier, that underscores a conservative and, importantly, accurate initial reserving process. That's really the hallmark of a high-quality insurance operator. They get it right up front more often than not.
Okay, so they're disciplined, they're profitable, they have an excellent culture baked in. How do they actually get their specialized products to market? Who sells AmeriSafe policies?
AmeriSafe distributes its products exclusively through a network of independent insurance agents.
Okay, the independent channel.
Yes. And in what seems like a sign of strategic maturity, management has recently focused on cultivating deeper relationships with its most effective agent partners, rather than simply trying to expand its network at all costs, just adding more names to the list.
Quality over quantity for agents too, then.
Seems to be the approach. And the strategy appears to be bearing fruit. The company reported that impressive 12.8% growth in voluntary premiums, that's new business, not just renewals or audit adjustments, in the second quarter of 2025.
That's strong growth.
It is, and they attributed that directly to working more effectively and closely with these key agents.
So why is that refined approach focusing on the best agents so crucial for them, do you think?
Precisely. This approach, focusing on quality over quantity, may temporarily slow the pace of raw agent appointments, but it's designed to yield higher quality, more profitable business over the long term. It further enhances their underwriting advantage.
Makes sense.
The company's high-touch service model, fostering direct relationships not just with policyholders but also between its internal experts and its agents, builds loyalty. And it provides an invaluable feedback loop of on-the-ground risk information.
Ah, intel from the front line.
Exactly. This is critical for staying current with the unique and evolving risks within their niche industries, and it ensures they are aligned with partners, the agents, who also prioritize quality and profitability over simple volume.
And to serve those small to mid-sized employers profitably in these complex industries, they must need a lot of operational efficiency, right?
Uh-huh.
Does technology play a big role here in making that work?
It absolutely does. You can't do this efficiently without good tech. The company provides policyholders with a suite of online services, things like making payments, reporting payroll, accessing claims information, all available 24/7.
Standard stuff, but important.
Very important for efficiency and convenience, especially for smaller businesses. And management has explicitly identified technology investment as a key strategic priority and a designated use of capital. The aim is twofold: improving the ease of doing business for agents, making it simpler and faster to quote and bind policies, and enhancing internal back-office efficiency. This is a crucial investment for sustaining their model, especially as they aim to scale without compromising that high-touch service level.
Got it. Okay, let's turn our attention fully to the numbers now. We know AMSF has this consistent ability to generate strong profitability, but the analysis points to some recent trends that reflect both those broader industry pressures we talked about and perhaps their own strategic shifts. What's the latest on their underwriting profitability?
Right. This section is really key to understanding the current dynamics and the near-term outlook. AMERISAFE's underwriting profitability remains a core strength, no doubt. That's evidenced by their excellent net combined ratio of 85.9% in both 2022 and 2023.
Still very strong.
Very strong. However, it did increase slightly to 88.7% in 2024, and then further to 91.7% in the second quarter of 2025.
Okay, ticking up a bit. Still profitable, but moving closer to 100.
Exactly. It's still a very good number, well below break-even, but the upward trend bears watching. This uptick reflects those rising loss costs we discussed, driven by severity, and also a slightly higher expense ratio.
So, bit of pressure there. What's driving the loss ratio component? The percentage of premiums paid out in claims specifically. Is it frequency or severity?
Primarily severity. The net loss ratio held steady at 55.5% in 2022 and 2023, which was excellent, before rising to 58.1% in 2024.
Okay.
This increase was primarily driven by two factors. First, a slightly smaller contribution from that favorable prior year reserve development, meaning less extra profit flowing in from past claims being settled for less than expected. It was around $35 million in 2024 compared to over $41 million in 2023.
So less help from the past.
Right. And second, the ongoing impact of medical inflation, which directly increases the cost of treating injuries for current claims. However, and this is important, it's crucial to note management's pricing discipline here. They've held the current accident year loss ratio, which reflects the estimated profitability of policies written just in the current period before any reserve development, remarkably steady at 71.0%.
Ah, okay.
This indicates they are not sacrificing their pricing standards for growth, even in the face of these cost pressures. They're pricing current business appropriately for the risks they see today.
That's a crucial distinction. They're controlling what they can control right now.
Okay, and what about the other piece, the expense ratio? The percentage of premium spent on operating costs, like salaries, commissions, technology, that's been trending upward as well.
It has. The net underwriting expense ratio moved from around 29.3% in 2023 up to 29.6% in 2024, and then further to 31.3% by the second quarter of 2025.
So costs are rising relative to premiums.
They are. But what's really crucial here is that management explicitly attributes this increase not to inefficiency, but to deliberate investments they are making to support and scale future growth. It's presented as a strategic choice, not a loss of control. Okay, this is a clear strategic trade-off than accepting higher near-term costs, potentially, for long-term profitable business. What does this tell us about management's forward-looking strategy, especially when the industry as a whole is facing those headwinds that we discussed? Are they swimming against the tide?
I think it tells us they are playing the long game. Instead of simply trying to slash costs to maintain short-term ratio targets, which might be tempting,
Right.
they are strategically deploying capital into areas they believe will drive future profitable growth, like technology enhancements and agent relationship development tools. They seem willing to take a temporary hit on the expense ratio, acknowledging the current industry headwinds, to position the company for more robust and profitable growth when market conditions eventually improve or as they continue to take share.
So it's a confidence vote in their own model.
It really is. It's a confident bet on their ability to continue finding and expanding profitable business within their niche, suggesting they see clear opportunities ahead that justify these upfront investments.
Okay, moving on to premium growth itself. The trends here seem pretty positive, which would be a good early sign for those strategic investments paying off.
They are quite positive, yes. Gross premiums written, or GPW, which is the total value of policies written, grew 3.1% in 2024 to $294.1 million. And importantly, that growth accelerated into 2025. GPW was up 4.6% in the first quarter and 4.3% in the second quarter.
Solid acceleration.
It is. But the real story, as we highlighted earlier, is digging into the voluntary premium growth. Remember, that's the metric that strips out the effect of things like payroll audits on past policies, giving us a clearer picture of new business production right now.
Ah, yes, the pure new business metric. What's that showing?
That's where it gets really impressive. Voluntary premiums on policies written grew a very strong 12.8% in Q2 2025.
12.8%. That's significant.
It is. This is a very strong indicator that the company's growth investments and that refined agent strategy, focusing on the best partners, are succeeding. And it's not just new business. Their value proposition continues to resonate strongly with their existing target market. Policy retention on renewals remained exceptionally high at 93.8% in Q2 2025.
Wow, keeping almost 94% of their clients.
Exactly. That sticky customer base is a powerful asset. It signals that policyholders really value AmeriSafe's specialized services and aren't just jumping ship for a slightly lower price, especially in these hazardous industries where expertise matters.
Now let's talk about their investment portfolio. How does AmeriSafe manage its significant assets, all the cash generated from premiums and profits? What's their strategy there?
They maintain a pretty conservative, high-quality investment portfolio. It's designed primarily for capital preservation and generating steady income rather than taking big risks for high returns.
Makes sense for an insurer.
It does. As of mid-2025, their roughly $887 million portfolio was mostly allocated to fixed income securities. About 62% was in municipal bonds, 21% in corporate bonds.
Most bonds.
It's mostly bonds, with only a small 7% allocation to equities or stocks. The overall portfolio carries an average credit rating of AA, which is very high quality, and it has a moderate duration of 4.5 years. All of that signals a cautious, risk-averse approach suitable for an insurer needing liquidity and stability.
I see in the numbers, though, that net investment income has actually declined recently.
Yeah.
Fell 6.8% in 2024 and another 10.2% year over year in Q2 2025. Is that a concern for a company known for its overall profitability?
That's a good observation. It has declined. But this is actually a direct and frankly expected consequence of the company's policy of returning significant capital to shareholders via those large special dividends we mentioned multiple times.
Because they paid out the cash, there's less cash to invest.
Precisely. When you distribute capital, you reduce the base of investable assets, so the income generated naturally goes down. However, this headwind from a smaller asset base is being partially offset now by the current higher interest rate environment.
How so?
Well, in Q2 2025, management specifically noted that yields on new investments they were making were exceeding the yields of the older bonds that were maturing by a significant 230 basis points.
So 2.3 percentage points higher yield on new money coming in.
Exactly. This will gradually increase the overall portfolio yield over time as older, lower-yielding bonds roll off and are replaced. So while the income dipped due to the special dividends, there's a positive tailwind now from higher rates that should help investment income recover and grow going forward.
Okay, that makes sense. Let's get to the bottom line. Overall profitability and returns. How does AmeriSafe measure up here, especially when you compare them to the rest of the insurance industry?
This is where they really stand out. AmeriSafe has consistently generated top-tier returns on equity, ROE, which, as you know, measures how much profit they generate for every dollar of shareholder equity. It's a key metric for investors.
And their ROE is?
They delivered an impressive ROE of 20.4% in 2023 and 20.2% in 2024.
20% ROE, that's huge.
It is. It's well above their stated target of achieving a top quartile ROE of 15% over a full insurance cycle. Even in Q2 2025, their operating ROE was a solid 14.9%, still a very strong performance. And with total assets of $1.2 billion and net income of $55.4 million in 2024, the company's return on assets, ROA, profit generated per dollar of assets, is also robust for an insurer, signaling they use their balance sheet efficiently.
We have some key figures summarized in the analysis that gives us a quick snapshot. Looking at the recent historical financial summary table provided, we can see their gross premiums, written steadily increasing from about $276 million in 2022 to over $302 million on a TTM, trailing 12 months basis, as of Q2 2025.
Right, showing that growth trend.
The net combined ratio, while still excellent, has ticked up, as you said, from 83.7% in 2022 to 90.9% TTM. Still profitable, but higher.
Reflecting those pressures, yes.
And net investment income saw that dip in 2024, down to $24.6 million from around $26 million the prior 2 years. For the reasons you just explained, the special dividends reducing the asset base.
Exactly. And if we look at net income, it was consistently strong, over $62 million in 2022 and 2023, then dipped to $55.4 million in 2024 and $48.4 million on a TTM basis ending Q2 2025. Diluted EPS has followed a similar trajectory.
Okay. But what's particularly noteworthy, and you flagged this earlier, is the book value per share. You'll see it actually declined from $16.57 at the end of 2022 down to $13.96 TTM Q2 2025. A declining book value per share usually isn't good news for a company, is it? I mean, that typically signals value destruction. This feels like a big disconnect from the profitability story.
That's right. It can be misleading here if you don't dig deeper. And this is such a crucial point for understanding value in insurance companies, especially ones that pay large dividends. You absolutely have to look beyond the headline book value figure sometimes.
But what's the real story?
This decline in reported book value per share is entirely due to the payment of those large special dividends, which directly return value to shareholders. It's not a sign of the business destroying value. It's a deliberate and significant transfer of capital from the company's book value directly into shareholders' pockets.
Okay. So the value didn't disappear, it just moved.
Exactly. When you adjust for these substantial distributions, the underlying growth in the company's intrinsic value, the economic value created by the business operations before any payouts, has actually been quite strong. It's a critical piece of context when analyzing their financial summary. It shows they are actively distributing the profits they generate, not just letting them pile up inefficiently on the balance sheet. It's a sign of shareholder-friendly management.
That's a great clarification. Okay, so it's clear AmeriSafe has this unique and effective model, consistently generating profit and returning a lot of it to shareholders. So where do they go from here? What are their growth opportunities and strategic initiatives for the future?
Right. Well, their primary growth engine is, and likely will continue to be, organic premium expansion.
Growing the core business.
Exactly. Driven by strong new business production, fueled by those effective agent relationships we discussed, and leveraging their high policy retention rates. The recent acceleration in voluntary premium growth to that 12.8% in Q2 2025 strongly suggests that management's strategy of focusing on a smaller, more productive group of agents is succeeding in capturing profitable market share right now.
So doubling down on what works.
Pretty much. This approach favors deepening relationships with high-performing partners over simply broadening the distribution network haphazardly. And that aligns perfectly with their focus on underwriting quality and ensures that future growth remains profitable growth.
I like that they have a clear framework laid out, what they call a capital ecosystem, for prioritizing long-term shareholder value. What are the key tenets of this approach? What guides their decisions?
It's a good framework. The key tenets include, first and foremost, maintaining their foundational A excellent rating from AM Best. That's non-negotiable.
Okay.
Second, they explicitly target a top quartile ROE of 15% through an entire insurance cycle, demonstrating their commitment to superior profitability, not just good results in good times.
Aim high.
They are. Third, they emphasize prudently managing all forms of asset risk in the portfolio, pricing risk in underwriting, reserve risk, and even catastrophe risk. And importantly, fourth, they explicitly state they plan on making strategic investments in technology and also considering potential acquisitions if the right opportunity arises.
And the CEO mentioned culture, too.
Yes, CEO Janelle Frost has further emphasized a service-oriented culture, referring to it internally as One AmeriSafe. This links growth not just to financial outcomes, but to delivering superior service and fostering partnership with all stakeholders, agents, policyholders, employees.
Okay, so they're active in 27 states, but licensed in an additional 20 states plus the U.S. Virgin Islands. That sounds like quite a long runway for future geographic expansion, doesn't it? They could enter new states without having to jump through entirely new regulatory hoops in many cases.
It absolutely provides a long runway for future geographic expansion into adjacent territories or states where they see opportunity, allowing them to scale their existing expertise relatively efficiently. What's notable, however, is that based on available materials, there is no indication that the company intends to diversify into new product lines like, say, general liability or commercial auto.
Sticking to their knitting.
Exactly. Their identity and their competitive advantage are deeply intertwined with their monoline focus on workers' compensation. Expanding beyond that niche would likely dilute their core strength and expertise, so we expect them to stick to what they do best, but perhaps do it in more places over time.
You mentioned technology earlier as a strategic priority within that capital ecosystem.
Yeah.
How does that translate into tangible benefits for growth and efficiency, especially for their specific market of smaller, high-hazard employers?
Right. Strategic investments in technology are a stated priority for capital deployment. These investments are likely aimed at, one, improving the ease of doing business for their independent agents, making it simpler and faster to, quote, bind policies and service clients.
Making agents happy.
Crucial. And two, enhancing their own back office efficiency. This is really crucial for profitably serving their target market of smaller employers, where the administrative cost per policy can often be higher than for large accounts. And this connects directly back to that recent deliberate increase in the expense ratio we discussed. It shows management is willing to invest now in systems and tools for future returns and operational leverage, rather than just focusing on cutting costs in the short term.
What about growth through acquisition?
Yeah.
M&A. Is that realistically on the table for Amerisafe, or are they more inclined towards purely organic growth?
Well, acquisitions are noted as a potential use of capital within their capital ecosystem framework, so it's officially on the list.
Okay.
However, the company's historical focus has been overwhelmingly on organic growth, building it themselves. But it's important to note that with no outstanding debt, Amerisafe possesses significant financial flexibility. They have the firepower to pursue M&A if a culturally and strategically aligned target were to become available.
What kind of target might fit?
You could imagine perhaps a smaller specialist insurer focused on a complementary hazardous niche, or maybe one operating in a geography where Amerisafe wants to expand. They certainly have the financial dry powder if the right deal came along at the right price. But historically, they've been very selective, prioritizing their disciplined approach over simply buying growth for growth's sake.
Okay, let's talk about capital more broadly now. How does Amerisafe manage its capital overall, and how do they ensure they're returning value to their shareholders, especially given all that cash generation and profitability we've discussed?
Right. Amerisafe's capital management philosophy is really designed around three core pillars. First, support their crucial A rating from AM Best that requires a strong capital base. Second, ensure they have sufficient capital to comfortably cover all their underwriting and investment risks. And third, after meeting those needs, maximize long-term shareholder value.
And they execute this from a strong position.
Very strong. They operate with a clean balance sheet, importantly, no outstanding debt, and a healthy statutory surplus, which is the capital cushion regulators look at. It was $257 million at the end of Q2 2025. This provides a very strong foundation to weather any storms and pursue opportunities without financial strain.
And their dividend policy is quite distinctive, as we've touched on. They're known for both growing ordinary dividends and those substantial special dividends. That's a powerful 1-2 punch for investors, isn't it?
It is, absolutely. Amerisafe has an outstanding and quite consistent track record of returning capital to shareholders via dividends. They've consistently grown their ordinary quarterly dividend, with the latest increase being 5.4% announced in 2025. That brought the quarterly payout to 39 cents per share, or $1.56 annually.
A solid regular payout.
Yes, but the real hallmark, the thing they are arguably best known for among investors, is the consistent payment of large special dividends on top of the regular ones.
And these have been pretty significant amounts.
Remarkably consistent and substantial. They paid out $3.50 per share in special dividends each year from 2017 through 2020. Then they upped it to $4 per share in both 2021 and 2022. It was $3.50 again in 2023 and $3 in 2024. These are large sums relative to the share price.
What does this consistent history of such significant special dividends signal about the company's cash generation and management's philosophy regarding excess capital? It certainly suggests a highly cash-generative business and disciplined management unwilling to just sit on cash.
Precisely. This history signals loud and clear that the underlying business is indeed highly cash generative, consistently producing capital well in excess of what is needed to support organic growth and maintain their strong financial ratings. It also reflects a disciplined management team that clearly prefers to return excess capital directly to shareholders rather than, say, pursuing potentially value-destructive acquisitions just to get bigger, or chasing unprofitable growth in a competitive market. It implies a strong commitment to shareholder-friendly capital allocation. They allow investors to benefit directly and immediately from their underwriting prowess, rather than diluting future returns through unnecessary retained earnings sitting on the balance sheet. It's a very clear message about where they believe capital is best utilized back in the owner's hands if the company can't deploy it at high rates of return internally.
Beyond those hefty dividends, they also use share repurchases as another capital return tool, right?
Right.
Buying back their own stock.
Yes. While dividends are clearly the primary method for Amerisafe, share repurchases serve as an additional tool in the capital return toolkit. They repurchased about $5.1 million worth of shares in 2024 and bought back another $2.8 million worth in the second quarter of 2025 alone.
So they are actively using it.
They are. And in July 2025, the board authorized a new $25.0 million share repurchase program, demonstrating a continued commitment to this avenue of shareholder return. It gives management another lever for optimizing capital structure and potentially boosting earnings per share over time, especially if they view the stock as undervalued.
Okay, so wrapping up this section on capital, what's the overall picture of their capital adequacy and financial flexibility? How robust are they feeling?
The big picture is one of significant strength. The combination of that strong A rating from AM Best, the debt-free balance sheet, and a healthy statutory surplus provides Amerisafe with considerable financial flexibility.
Which lets them do what?
It allows them to confidently navigate economic cycles, fund those strategic initiatives like technology investments we discussed, and continue their robust capital return programs, both regular and special dividends, plus buybacks without undue strain. They have a strong financial buffer against unexpected negative events, which is exactly what you want to see in an insurance company.
Okay, let's talk about the very latest developments and the forward-looking outlook, covering roughly 2023 through mid-2025. The operating environment for Amerisafe seems to be, well, a mixed bag, strengthening execution internally versus a more challenging, broader industry. What's the current pulse? What did the latest results show?
Right. Recent quarterly results have been characterized by a bit of a dichotomy. On one hand, the headline earnings modestly missed analyst expectations, but on the other hand, there was strong underlying growth in the core business.
Okay, tell me more.
Specifically, in Q2 2025, the company reported adjusted earnings per share of 53 cents, which was slightly below the consensus estimate of 55 cents.
A slight miss.
A slight miss. However, this was largely overshadowed, at least in terms of market reaction, by that significant 12.8% surge in voluntary premium growth we keep coming back to.
New business metric.
Exactly. Investors rightly recognize that as a strong positive indicator for future performance and a validation that their strategic initiatives are gaining traction even in a tough market. So maybe slightly lower profit now due to investments, but strong growth feeding the future.
And there was some interesting commentary from management during that Q2 earnings call about California. Why is that specific detail potentially so important, especially since Amerisafe doesn't have much exposure there itself?
Yeah, that's a great question, as California is often seen as a bellwether, a leading indicator for insurance trends across the country, particularly in workers' comp. During the Q2 2025 earnings call, management pointed to a significant 8.7% approved increase in loss costs in California.
An increase after years of decreases.
Exactly. While Amerisafe has minimal exposure there, so it doesn't directly impact their bottom line much, this is a potential leading indicator that the multi-year trend of declining rates across the industry could finally be nearing an end or even revising.
The turning point.
Potentially. A definitive turn in the pricing cycle would be a significant tailwind for the entire industry, potentially alleviating some of that margin compression we discussed earlier. It's a development investors are keenly watching as a possible harbinger of broader market change. Too early to call it a trend, but it's a hopeful sign for insurers.
Okay, so turning to the macro environment. Inflation remains a persistent headwind for the industry, especially for claims costs. How is Amerisafe managing that specifically?
Absolutely. Management has openly acknowledged that rising medical inflation in particular contributed to an increase in their loss expenses in 2024. This remains a primary industry headwind, as higher medical costs and, to some extent, wage costs directly increase the ultimate cost of claims, the severity component.
Right, but interest rates are a different story.
Yes. On the flip side, the higher interest rate environment is actually a net positive for Amerisafe's investment income over time. As their existing bond portfolio matures, it is being reinvested at significantly higher yields. Remember that 230 basis point pickup in Q2 2025?
Yeah, new money earning much more.
Exactly. That will gradually boost the portfolio's overall yield and therefore net investment income over time, providing a nice offset to some of the underwriting pressure. So they have an inflation headwind on claims costs, but an interest rate tailwind on investment income. It's a complex operating environment with pushes and pulls.
How do labor market dynamics, things like employment levels, wage growth, maybe even workforce demographics, tie into all of this for AMERISAFE?
They're critical. The health of the labor market is a direct driver of workers' compensation premiums. Fewer jobs mean less payroll, which means less premium for insurers like AmeriSafe. So they watch employment trends closely, especially in their key industries.
And safety trends within those industries matter too.
Absolutely. Trends in workplace safety within AmeriSafe's key industries are also critical. Recent research from NCCI, for instance, indicates that the construction industry has achieved a significant long-term decline in claim frequency, fewer accidents per hour, worked likely due to improved safety protocols, and maybe longer average worker tenure.
That's good news.
It is. However, claim severity in construction, the cost of each claim when it does happen, remains elevated due to the nature of the work. Serious injuries are still common.
And trucking.
The trucking industry, in contrast, has seen less improvement in motor vehicle accident frequency, which remains a key driver of severe, high-cost claims for them. And looking demographically, things like labor shortages combined with an aging workforce, particularly in construction, can also present challenges. Injuries to older workers often result in higher medical costs and longer recovery times, pushing severity up.
Lots of moving parts there. And finally, the regulatory landscape still seems to be generally a headwind, pushing rates down in most places.
Largely, yes. The regulatory environment generally continues to approve rate and loss cost decreases for workers' compensation across many states, reflecting those past positive trends in frequency and reserves.
But California is the exception.
Right. However, that aforementioned rate increase approved in California is a notable exception and a key development for investors to monitor. It's being watched closely as a potential harbinger of a broader shift in the pricing cycle. If other state regulators start acknowledging the rising severity trends and approve rate increases too, it could be a significant positive catalyst for the industry, providing a much-needed boost to top-line growth and underwriting margins. But for now, it's mostly still a headwind outside of California.
Okay, no investment analysis is complete without a thorough understanding of the risks involved. Given AmeriSafe's unique niche and the current environment, let's break down the key risks for them. What keeps management up at night?
Good question. The most significant risk for any property and casualty insurer, AmeriSafe included, is always the potential for inadequate loss reserving. Setting aside enough money today for claims that might take years to fully pay out.
Even with their great track record.
Absolutely. While AmeriSafe has that exceptional 17-year track record of favorable reserve development, that is absolutely not a guarantee of future results. History doesn't always repeat.
So what could cause reserves to turn negative?
A sustained and unexpectedly high surge in medical or wage inflation, higher than what they built into their assumptions, could cause actual claim costs to exceed the established reserves. That would lead to adverse development, which would directly and negatively impact earnings.
Okay. And what about pricing risk?
That's the other side of the underwriting coin. In a competitive soft market, there is always the risk of mispricing policies in the pursuit of growth, trying to win business by cutting prices too much. That would lead to a higher loss ratio in future periods when those claims come due.
But they seem disciplined there.
To date, yes. The company's steady current accident year loss ratio suggests this discipline is being maintained. But it's a constant battle, especially when competitors might be pricing irrationally.
What about their financial risks, particularly with their investment portfolio? How susceptible are they to market swings or crises?
Well, AmeriSafe's conservatively managed investment portfolio is primarily exposed to two main risks. First, credit risk on its corporate and municipal bond holdings. That's the risk that the issuers might default and not pay back the principal or interest.
Okay.
Second, it's exposed to interest rate risk. Rising rates decrease the market value of existing fixed income securities, although their moderate duration helps manage this volatility somewhat. A major financial crisis, of course, could lead to widespread defaults and a significant decline in the value of the portfolio.
And liquidity.
Yes, beyond the portfolio itself, the company must always maintain sufficient liquidity, enough cash, or easily sellable assets to pay claims as they come due. That's a constant balancing act for any insurer managing assets against liabilities.
And the broader industry and macroeconomic risks we've discussed, things like recession, competition, inflation. How directly do those impact Amerisafe given its specialized focus? Does the niche insulate them at all?
It provides some insulation, but they're definitely not immune. Amerisafe is exposed to the cyclicality of the P&C insurance industry and the wider economy. A severe recession, particularly one that disproportionately affects construction and freight activity, their core industries, would directly reduce Amerisafe's premium base as payrolls shrink in those sectors.
Right.
Persistent irrational pricing from competitors, as we discussed, could force a difficult choice between losing market share or writing business at inadequate rates, although their discipline usually leads them to choose losing share over losing money. And finally, sustained high inflation remains a direct threat to their underwriting margins by continuously pushing claim severity higher, impacting their ultimate profitability regardless of their niche focus. Costs are costs.
When we think of catastrophic losses in insurance, we usually think of hurricanes or earthquakes hitting property. But for workers' compensation, it's a bit different, isn't it? What does catastrophe risk look like for Amerisafe?
It is different, yeah. While workers' compensation isn't typically viewed as a catastrophe-exposed line like property insurance, a single event that causes numerous severe injuries at one location could represent a catastrophic loss for Amerisafe.
Like what kind of event?
Think, for example, a major building collapse on a construction site injuring dozens of workers, or a multi-vehicle accident involving a fleet of trucks, or even, unfortunately, a terrorist event impacting a work site with many employees.
Okay, a concentration of severe injuries from one event.
Exactly. Amerisafe mitigates this specific type of risk through a comprehensive reinsurance program. They essentially buy insurance from other insurers, called reinsurers, to cover losses above a certain large threshold from a single event.
So they transfer some of that extreme tail risk.
Precisely. It protects their balance sheet from that low probability but potentially very high impact single loss event. The continued availability of this reinsurance protection at reasonable prices is a key operational necessity and always listed as a disclosed risk factor for them. It's a vital safety net for their business model.
Okay, so we've covered the business, the industry, the financials, and the risks. Let's bring it all together now with valuation. How does Amerisafe's market price stack up against its peers and its own history? And what does it tell us about how investors view the company and its prospects?
Right, valuation is key. Compared to a peer group of other specialty property and casualty insurers, Amerisafe consistently trades at a premium valuation.
Meaning a higher price-to-earnings ratio or price-to-book?
Yes, typically both. And this premium valuation is generally seen as justified by its superior and, importantly, more consistent profitability metrics, particularly its sustainably higher return on equity that we discussed. The market, in essence, is pricing Amerisafe as a higher quality, more profitable business than its average peer, and that view is strongly supported by its long-term performance track record.
So it commands a higher multiple. Looking at the peer valuation and performance metrics table provided in the analysis, what stands out as the key differentiator driving that premium?
Exactly. If you look at that table, you see Amerisafe's price-to-earnings PE ratio might be around 17.5x on a trailing 12-month basis, maybe slightly above the peer group average of, say, 16.7x. But the real difference is in the performance metrics underpinning it.
Like the ROE.
Precisely. Look at their TTM ROE of 20.2%. Compare that to peers where it might be lower or even NA. And crucially, look at their combined ratio, 88.7% TTM for Amerisafe, compared to, say, Employers Holdings, EIG, at 98.6% in 2024, excluding a specific transaction. That clear performance difference, significantly better underwriting profitability leading to higher returns, is what supports the premium valuation.
But there's a catch.
Well, the key question for investors now is whether the size of this premium is appropriate given those emerging industry headwinds we've talked so much about. If industry-wide margin compression starts to significantly impact Amerisafe too, causing its ROE to maybe revert closer to the peer average over time, then logically its valuation premium should also shrink.
So it's a bet on continued outperformance.
It is. It's a balance of acknowledging their historical quality versus assessing the sustainability of that quality premium in a potentially tougher future market.
And that premium valuation, that's been a consistent historical trend for them, not just a recent thing.
Yes. An analysis of Amerisafe's historical price-to-book valuation range indicates that the company consistently trades at a premium to its accounting book value, and that's directly a function of its high ROE.
How does that relationship work?
Well, think of it this way. For high-quality insurers, a price-to-book multiple of maybe 1.5x to 2.0x is often considered reasonable if the company is generating an ROE in the mid-teens, say 15%. AMERISAFE's often higher multiple, sometimes over 3x historically, reflects its ability to consistently generate an ROE at or above 20%. The market pays more for each dollar of book value because that dollar generates a higher return. Therefore, the valuation is highly sensitive to the sustainability of that high level of return. If the ROE drops, the justification for the high PB multiple weakens. That's why monitoring those industry headwinds and their impact on profitability is so critical for valuation.
You touched on this earlier, and it's such a crucial point that often confuses investors, especially with insurers. Book value per share. The analysis states that for a stable insurance company, long-term total shareholder return is primarily driven by two things: the growth in book value per share plus the dividend yield. Yet, as we saw, AMERISAFE's reported book value per share has actually declined in recent years, from $16.57 in 2022 down to $13.96 in Q2 2025. This seems to completely contradict the idea of a healthy, growing company driving shareholder returns through book value growth.
Yes, it absolutely seems contradictory at first glance, and this is a critical nuance for understanding value creation in insurance companies, particularly those like AMERISAFE that return significant capital via dividends. You absolutely have to look beyond the headline reported book value figure sometimes.
So what's the reconciliation?
Yeah.
How can declining book value be okay?
While the reported book value per share has indeed declined, this is entirely due to the payment of those large special dividends. Think about it. When they pay a $3 or $4 special dividend, that cash leaves the company's balance sheet and goes directly into shareholders' pockets. It reduces the company's book value dollar for dollar.
So the value isn't destroyed, it's just transferred directly to the shareholder.
Exactly. It's not a sign of the business destroying value. It's a deliberate and significant transfer of value from the company's book value to the shareholders. When you adjust for these substantial distributions, essentially adding back the special dividends paid out the underlying growth in the company's intrinsic value, the economic value created by the business operations before any payouts has actually been strong and positive. It's a sign of a shareholder-friendly management returning excess profits, not a sign of a shrinking business.
That's a vital distinction. Okay, so putting all these pieces together, the business quality, the headwinds, the valuation, the capital returns, how do we assess AMERISAFE's intrinsic value against its current market price? What's the market really betting on here?
Synthesizing all the quantitative and qualitative factors, AMERISAFE clearly appears to be a high-quality insurance franchise. It's trading at a valuation that reflects and is arguably justified by its historical record of excellence, particularly its high ROE and consistent underwriting profits.
Okay.
The current market price, therefore, seems to imply a bet by investors that the company can successfully defend its superior profitability against those industry headwinds of inflation and pricing pressure. An investment at current levels is, therefore, fundamentally a bet on continued executional excellence by management and the enduring strength and relative insulation of its high-hazard niche.
And is that bet supported?
Well, the company's intrinsic value is strongly supported by tangible factors. Its durable competitive moat built on specialized knowledge, its demonstrably disciplined management team, and its robust debt-free capital position. Whether the current price fully reflects the risks versus these strengths is the key judgment investors need to make.
Now for the classic deep dive conclusion, the bull case versus the bear case. Let's start with the most optimistic view. The bull case for AMERISAFE. Why invest?
Okay, the strong investment case, the bull case for AMERISAFE, rests on its status as a truly best-in-class, disciplined underwriter. They possess a durable competitive moat in a profitable, albeit challenging and somewhat underserved niche market.
Okay.
They have that multi-decade track record of generating superior underwriting profits and high returns on equity, demonstrating consistent operational excellence through various cycles. It's led by a shareholder-friendly management team with a proven history of robust and disciplined capital returns, both those growing regular dividends and the substantial special dividends.
And the balance sheet.
The balance sheet is pristine. It's debt-free, providing significant financial flexibility for operations, investments, and continued capital returns. And critically, recent results show that acceleration in organic growth in its core business, suggesting that their strategic investments are paying off and the company is successfully navigating a competitive market to gain profitable market share right now. Bulls see continued execution and resilience.
On the flip side, what are the primary risks? What's the bear case? What would make an investor wary of AMERISAFE right now?
The primary risks, the bear case, stem mainly from those industry-wide headwinds we've hammered on. The entire workers' compensation sector faces a potential margin squeeze from the dual pressures of falling premium rates, the soft market, and rising claim severity due to medical and wage inflation.
And AMSF is right in the thick of it.
They are. As a monoline insurer focused only on workers' comp, Amerisafe is fully exposed to this cycle with no diversification from other lines of business to cushion a potential downturn in this specific market. Internally, the company's expense ratio is rising, albeit due to deliberate growth investments, which still pressures near-term margins. And that significant tailwind from prior year reserve releases, that extra profit boost from past claims, may diminish in the future as reserves become less redundant across the industry, removing a key historical support for earnings.
And the valuation risk.
Exactly. The stock's premium valuation relative to peers leaves little room for error. If performance were to falter, perhaps due to those industry headwinds proving stronger than expected, it could lead to both lower earnings and a contraction in its valuation multiple. That's a potential double negative for investors' lower profits and a lower price tag on those profits.
So with those bull and bear cases laid out, what could really move the needle for AMSF, positively or negatively? What are the key catalysts investors might watch for, and what factors help mitigate some of those bear case risks?
Okay, potential positive catalysts could include a definitive turn in the workers' compensation pricing cycle. Like, if that California rate increase truly becomes a broader trend across other states, that would provide a major tailwind.
Right.
Continued acceleration of profitable voluntary premium growth would further validate the company's current strategy and execution. And of course, the announcement of another large special dividend would reaffirm their cash-generating power and management's ongoing commitment to shareholder returns, likely boosting sentiment.
And the risk mitigants. What provides comfort against the bear case?
The primary risk mitigant is management's long and successful track record of disciplined execution through various market cycles. They've navigated tough times before. Also, the less price-sensitive nature of its high-hazard niche provides some insulation from the worst of the industry's competitive pricing pressures. Expertise matters more here. And of course, that strong debt-free balance sheet offers a significant financial cushion to weather potential storms and continue pursuing strategic initiatives without distress.
So wrapping it all up, what does this mean for you, the listener, potentially looking at AMSF for your portfolio? How does it fit into a broader investment strategy? What's the final takeaway?
I think AmeriSafe represents a compelling investment opportunity, particularly for long-term, value-oriented investors who appreciate quality. It is clearly a high-quality, shareholder-friendly company with a definite and defensible competitive advantage in its chosen niche market.
But it faces headwinds.
It does face industry headwinds, no question.
Wow.
However, its operational execution appears to be strengthening, as shown by that recent voluntary premium growth. This positions it well to potentially outperform peers through the current cycle, even if the overall industry faces pressure.
How might it fit in a portfolio?
Within a diversified portfolio, AmeriSafe could be considered a core holding in the financial sector. It offers a combination of attributes investors often seek: value, given its profitability; quality, due to its moat and track record; and income from its regular and potential special dividends. Also, its business model has historically produced results with lower volatility than the broader market it sought as a low beta, around 0.38, meaning it tends to swing less wildly than the overall market.
And the time horizon.
The investment time horizon should probably be long-term, think 3 to 5 years or more. This allows time for the insurance cycle dynamics to play out and for the full benefits of management's current strategic investments in technology and growth to mature and be reflected in results. The path to attractive total shareholder returns here seems clear. It's a combination of that growing ordinary dividend, the significant potential for ongoing special dividends, and steady growth in the underlying intrinsic value or adjusted book value over time.
And that, deep divers, brings us to the end of another fascinating exploration. We've truly taken a deep dive today, exploring how AmeriSafe has not just carved out, but really powerfully defended a highly profitable niche in a genuinely challenging industry. From their unique underwriting philosophy and that integrated risk management system to their disciplined capital allocation and the current industry headwinds they so skillfully navigate, it's just a profound study in specialized business excellence.
Yeah, you've now got, hopefully, a comprehensive understanding of what makes a company like AmeriSafe stand out and the delicate balance required to thrive when you deliberately choose to focus on, well, the riskiest clients out there. It's really a powerful reminder that sometimes specialization isn't just a strategy. It can be a competitive superpower.
So, as you reflect on Amerisafe's remarkable journey, maybe consider this. In an increasingly complex and competitive world, where generalists often struggle just to maintain market share, could extreme specialization, when combined with unwavering discipline, actually be the ultimate form of innovation, carving out enduring value where others genuinely fear to tread? Something to think about. Thank you for joining us on this deep dive. We hope you feel more informed and equipped to think critically about niche markets, insurance, and investment strategies. Until next time, keep digging.